Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and anyone investing in stocks for long enough, you know about that risk-return trade-off. The idea that to book those higher returns, you have to invest in riskier stocks. Stocks like GameStop that can surge 20-fold in a month or lose 85% just as fast. There is no return without the risk. But that doesn't mean you have to take on too much risk to find those great stocks, or that you can't tilt the odds just a little bit in your favor for that higher return on lower risk. In this video, I'll show you how to find those high return stocks and how to separate the risky from the just plain crazy. We'll put together a screener for stocks to buy that is going to grow your portfolio but won't make you lose sleep. Then I'll reveal 3 high return stocks that may be risky but are also good investments. We'll be using stockcard.io to start our search. I'll leave a link to StockCard in the video description below. Click through and then go to the portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock picks section. It's free to follow, and you'll get email notifications whenever I buy or sell from the portfolio. As a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BowtieNation, all one word in lowercase, for an exclusive discount beyond the free trial. Let's get started, but first, I gotta send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. We'll start here on StockCard, and if you go to the dashboard, you can see these featured collections, which are just interesting groups of stocks around different themes. And this was actually the inspiration for this video, this Stocks for Risk Takers collection. And if we click through, we see there are 222 stocks to watch in that group. Now the criteria for that risk taker stock list is companies under $10 billion market cap. And that filters for companies with a mid-cap market size or lower, and that's typical of a high-risk, high-return screener. Smaller companies just tend to grow faster. They can focus better on a portion of the market, and it's a lot easier to grow sales 20% or more on a base of $5 million in sales rather than $500 million. The screen also filters for companies with revenue growth of 5% or more on an annual and 3-year basis. And now I'd like to see that a little bit higher here. 5% isn't much for sales growth, and I usually want to see 15 or 20% growth on these kinds of high return stocks. This filter for a current ratio above 1.0 and for balance sheet cash above annual operating expenses is a great one. It really helps screen out some of those really risky stocks. The current ratio is the company's current assets, so the things that can turn quickly into cash relative to its near-term liabilities, the things it needs to pay within the next year. It's a great measure for short-term liquidity for a company and how well it can cover those debts. So then having that current ratio above 1.0 means the company has enough of those cash-like assets to cover all its near-term obligations, and then cash greater than the operating expenses means it can go even further than that, using that cash reserves to pay all the upcoming business costs. But now if I want to narrow that list to find those with a little less risk, and because I really don't want to research 222 stocks, I can start a new screen here. Then I can search for the risk taker stock collection and add it to the screen, so we start with those criteria. Now I'm just going to filter for a few more fundamentals to narrow the list. I'll filter for stocks with positive sales growth for those growing that top line. I'll also want to screen for those with a record of positive earnings per share. Finally, I'll also narrow this down to micro-cap and small-cap companies, those with a market size between $50 million to $2 billion, and apply these filters. And here we see that narrows the stock list down to just 85 companies to start from. And this is mostly just to tighten up those criteria. By filtering for positive sales and earnings trends, I narrow that list to companies that have proven they can perform against their peers. Now, even if you're investing in some of these riskier stocks, as long as the company is growing sales and profits, you know that stock price is going to increase over time. Then narrowing our list to those micro and small cap stocks really filters out the super small companies, the riskiest of the risky. But it also keeps us in those small cap companies with the flexibility to outperform. And first on our list isn't that risky, but still offers a solid return. $1.26 billion Netgear Incorporated, ticker NTGR. Netgear is the leader in home internet connections with more than 40% of the US home Wi-Fi market and 55% of that retail switch market. Basically, if you've got a Wi-Fi router or other equipment at home, it's probably Netgear. Now, the company has been around since 1996, but new opportunities in networking equipment could help it refresh for some new company growth. Besides that lock on the home market, I really like Netgear here for the subscription cloud service, which gives it a recurring revenue stream on 437,000 users. And the company actually benefited from the lockdowns as everyone rushed out to update their home Wi-Fi connections. And Netgear booked 26% sales growth last year and is expected to hit $1.34 billion in revenue this year. Now that is slower growth, but still a solid 7% over the year, and the rest of the financials look great. Netgear has improved its operating profitability from 6.4% in 2019 to 8.25% last year, so producing more profits on those sales. Now, balance sheet cash has grown by more than $170 million to $370 million last year, with only $33 million in debt for the most recent quarter. Now, that's almost a third of the value of this stock, backed by cash. I think the company continues to book strong sales growth in that boom on small business and home office demand for connectivity, and that giant cash pile could be a big surprise this year. Nearly $400 million in cash, so the company could either return it to shareholders, make an acquisition, or just become a takeover target on the cash alone. Shares are trading for just 0.94 times on a price-to-sales basis, and the average analyst target of $49.70 a share would mean a 20% upside just from here. Next on our list is more of that high-risk, high-return theme with Egain Corporation, ticker EGAN. Egain is a software-as-a-service provider in customer service and messaging applications with chat assistants, email, and social media. It's got a strong driver in that AI for its applications, and this is another one of those recurring subscription business models, so revenue growth and stability. Total revenue was up 8% on a year-over-year basis in the last quarter, but up 14% in its core SaaS segment. Now, the company is expected to reach $77 million in sales this year, and remember, this is on only a $340 million company, so that's something you just don't see that often, that kind of a small cap company putting up those kinds of revenue numbers. It's also another one with a big cash stockpile, over $50 million in net cash. That's 15% of the market cap backed by cash, and the company is a constant innovator. Egain launched its virtual financial coach product in March, an AI-powered engagement service now piloting at 25 credit unions. Shares trade for a price of 4.4 times sales, fairly low for a software provider, and sports a 17% upside to that average analyst target of $12.86 each, but I think this one goes much higher over that longer term. Another stock here in a high-growth industry, $1.24 billion Enlight Inc., ticker LASR. Enlight develops semiconductor and fiber lasers for multiple end markets, including industrial use, microfabrication, as well as aerospace and defense. Revenue was up 26% last year and is expected to reach $270 million this year for growth of 22%, and that's well diversified across all three markets. And you know by now, I'm a sucker for a strong balance sheet. Enlight has more than $185 million in cash against just $18.6 million in debt. So like these others, a net cash position that amounts to a sizable chunk of the stock's value. And for catalysts on this one, the market for semiconductors is booming, and the company grew sales in its microfabrication unit by 47% last quarter. It's got over 500 issued and pending patents in a high-growth market and cash-rich balance sheet. So just on that, I wouldn't be surprised at all if this becomes a takeover target as well. Shares are trading for a price of 5.1 times sales. Again, not all that high for a company booking that kind of sales growth. There's an 18% upside to the $34 average analyst target, but I like this one all the way up to $40 at least over the next year and higher beyond that. Click on the video to the right for the 3 small cap stocks I'm buying right now. 3 more of those high risk, high return stock ideas. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.